Google has become one of the most recognizable brands in the world and the backbone of one of the most profitable tech companies in the world, Alphabet. The search engine completely revolutionized how people use the internet and access the world's information. So much so that people say just Google it. And it's this search engine which has powered the growth of a company now valued at over $2 trillion. And a large chunk of that valuation comes from their advertising business built through their search engine. Anytime you search something and you see these sponsored links at the top of the results, people paid for that. And there's an entire ecosystem of people bidding for different keywords in Google search. Today, Google has countless products across many categories. That includes top entertainment services like YouTube, productivity software like Docs and Sheets. And while they have an insane amount of products, analyzing Google's business and how they actually make money is a little more simple. And as I mentioned, this is an incredibly profitable business. They generate over $300 billion a year in annual revenue and over $100 billion in annual cash from operations. Since going public in 2004, Google stock has a 6,658% total return. That's a 23.1% compound annual growth rate. Over the past 10 years, they've had a 519% total return, or a 20% compound annual growth rate. And despite a poor 3-year return, the 5-year total return for Google stock is still 158%, or a 20.9% CAGR. And this past fiscal year, they just started paying a quarterly dividend, and it remains to be seen whether or not they become a long-term dividend growth stock. They most certainly have the profits to be able to do so, not to mention the impressive balance sheet. In today's video, I'm going to do a full review on Alphabet, ticker symbol GOOGL. That will include a look at the company's business model, explaining exactly how they make money. I'll do a full overview of the company's key financial metrics, discounted cash flow valuation on the stock, giving my estimate for intrinsic value. I will also share why Google is one of the newer additions to my long-term dividend growth stock portfolio. And at the end of the video, I will of course have to mention the US monopoly case going against Google, the potential risks that could cause to your investment, and what I think is likely to happen. With that said, let's roll the intro. My name is Zach, this is Dividend Data. You should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool, which is available at dividenddata.com. Here you can get all the important financial metrics for analyzing a public stock, and this is really designed with the long-term dividend growth investor in mind. And of course, you also get access to our new AI investment analyst. Think of this as ChatGPT, but specifically designed to help you analyze stocks. The best time to join dividenddata.com is today. You can get 50% off for life. And this sale is going to be over after Black Friday and Cyber Monday, so get it while it lasts, and it is the best deal we will ever offer. Click the link in the description and pinned comment. So first, let's just take a broad look at Google stock and its financials. The company trades under two different symbols, GOOGL and GOOG. The current stock price is $169.12. Over the trailing 12 months, GAAP EPS was $7.54, which is a 22.4p ratio. And as I mentioned, they are a new dividend payer. Their annual dividend is 80 cents per share, giving it a 0.47% dividend yield. So this is a small dividend yield, but it's also an extremely low payout ratio. And the company currently has a market cap of $2.08 trillion. That makes them the 5th most valuable company in the world, behind Apple, Nvidia, Microsoft, and Amazon. Google has seen fantastic stock price growth that has been backed up by growth in earnings per share. And in hindsight, they had a huge buying opportunity in 2022 and early 2023. And that happened from a decline in earnings per share due to a weak advertising market. This was seen to an even greater extent in Meta's business, which is an even more pure play on digital advertising. For Google stock, revenue per share is growing at an 18.41% 10-year compound annual growth rate. That's a 3-year CAGR of 21.99%. Net income per share has grown at a 19.84% 10-year compound annual growth rate. That's a 25.48% 8% 3-year CAGR. Free cash flow per share is growing at a 20.55% 10-year CAGR. That's a 3-year CAGR of 20.48%. However, in fiscal 2024, free cash flow per share is actually declining, and this is due to an increase in CapEx, which is one of the risks I will discuss throughout the video. So more on free cash flow and what they are actually spending this CapEx on later in the video. Alphabet has a fantastic high margin business. In the latest quarter, their gross margins were 58.68% with 32.31% operating margins and a 29.8% net margin. And their most profitable and highest revenue part of their business, being advertising, is actually their highest margin business segment. And this company has been printing profits for decades now, and they were not paying out any dividends during that time. So the Alphabet balance sheet is just incredibly strong. They have shareholder equity of $314.1 billion. They currently have $93.2 billion of cash and short-term investments and negative $66.3 billion of net debt. The only negative with Google's financials is they have a significant amount of stock-based compensation, and they do this so they can retain the best talent in the world. And as you can see, that has grown massively over the past decade, now at $5.8 billion a quarter. And relative to their free cash flow, that's significant. As I mentioned, the company is now just starting to pay a dividend that will likely grow over time. And they do repurchase shares as well. Their shares outstanding have been declining in recent years. And last year, they bought back over 3% of their shares outstanding. And for context, that's a lot more money than they pay in dividends. Last quarter, they paid $2.46 billion of dividends, and they repurchased $15.29 billion of shares. But let's take a deeper look and understand how Alphabet actually makes their money. First, they have Google services, which is the overwhelming majority of their business. That includes both advertising and subscription businesses like Google Search, YouTube, Google Play, and their hardware products. And this segment is primarily driven by advertising revenues from Google Search and YouTube. More on this later. Next, you have Google Cloud, which is significant. It's the third place competitor behind Amazon Web Services and Microsoft Azure. It basically offers cloud infrastructure and platform services as a service. So a developer as small as me or a large corporation, instead of having your own data center, you can use these public clouds. And cloud is one of the big growth businesses into the future. And then something often forgotten at Alphabet is their other bets category. And this is what they consider moonshot businesses like Waymo, their autonomous vehicle taxi service. And that one has actually grown significantly over the past year. So that could become a pretty profitable business in its own right. Although I do not think they will be the dominant player in that category. I think they will eventually lose to Tesla. But this is a very promising business that is continuing to increase in value. And then they have other health technology initiatives. And if you want to read into it, you can go down the rabbit hole pretty good on it. But in terms of analyzing Google stock, it's difficult to assign value to it as it's not a large business. And if we break this down even further, you can see that over the trailing 12 months, Google Search is their largest business segment at 56.5% of revenue, or $192 billion. And this is high margin advertising revenue. Google Cloud is now their next largest revenue source at 11.91%. However, this is lower margin compared to their advertising business. And then next in terms of revenue is Google subscriptions, platforms, and devices at 11.62%. That's followed up by YouTube ad revenue at 10.26% and the Google network revenue at 9%. Google network is basically anytime you see Google ads on a web page or blog. You can see that the other bets at this time make up less than 0.6% of revenue. And if we look at Google's latest quarterly report, you can see that advertising is by far their biggest business, and it's also their most profitable business. They report their business segments under Google Services, which includes the subscriptions, platforms, and devices revenue. But as you can see, Google Services accounted for $30.8 billion of profits in the latest quarter. So in terms of accounting for Google's valuation as a stock, almost all of it has to go to their advertising business. That is the cash cow at Google. Google Cloud, although it's a fast growing and increasingly more important business, that only accounted for $1.9 billion of operating income in the latest quarter. It is growing fast though. Year over year, that went from 266 million to 1.9 billion. But it's going to take a decade of high growth to become more significant to profitability compared to Google's advertising business. Since fiscal 2017, Google Cloud had $4 billion of revenue, and over the trailing 12 months, they're up to $40.46 billion of revenue. And this will continue to grow fast and become a larger percentage of Google's business. It went from 3% to nearly 12%. And I want to reiterate that this will be a great long-term growth business for the company. But if you're analyzing Google stock today, almost all of the value comes from their advertising business. Specifically, Google Search is the cash cow. So anything that disrupts Google Search and their profitability will be a problem for the company. But I do want to give some credit as well for their other advertising businesses. Specifically, YouTube is a fantastic business, and in my opinion will be the most valuable media asset over the long term. YouTube ad revenue has grown from $8.1 billion in fiscal 2017 to $34.8 billion over the trailing 12 months. Now larger and much faster growing than the Google network revenue, which is those ads you see on people's websites. The Google network is by far their worst ad business and has basically been completely flat since fiscal 2021. That is not a growth business for them long term. If you are analyzing Google, you have to figure out how you think about Google search, YouTube ads, and then Google Cloud. And there are some major risks and uncertainty around Google search. And that comes from two fronts. One, competition and disruption from new artificial intelligence competitors such as ChatGPT and Perplexity. And two, somewhat ironically, given my first point, is the monopoly cases from the DOJ. And those are specifically targeting Google search, and they want to break up Google. And those are key risks to understand when analyzing Google stock, and they will impact how you value the company because they introduce major uncertainty around key business segments at Google. But that doesn't mean their business segments don't have intrinsic value, and they will be incredibly valuable whether together or separate. So before I get to valuing Google stock and comparing to price targets, let's go over the risks. Now, I do think there's a pretty compelling argument that Google had a monopoly in a lot of ways, but it's also undeniable they're facing more competition than ever right now. And one example of that is SearchGPT in OpenAI, and this is now included in ChatGPT. And I just tried ChatGPT for search to figure out what's going on with this DOJ lawsuit and the monopoly case against Google, and frankly, they did a way better job than Google search did. So for certain types of questions and prompts, AI is going to do a far better job than Google search, and that will incrementally start to take searches away from Google. And by the way, my AI on dividend data did a better job than Google as well. But incrementally, this will slowly chip away at some of the searches that Google may have gotten. However, Google is definitely competing in AI themselves. They have their own model, Gemini, and they do have the technical expertise and definitely the data in order to compete very strongly in this category. And what Google is actually doing is they'll put an AI response at the top of search results. That way they can still retain their whole search experience, plus the profitability of ads that come from that. However, I do want to note this is interesting. I typed the same question I put into ChatGPT and dividend data, and they said an AI overview is not available for this search. I guess Google doesn't want to talk about them being a monopoly. So for the core product of Google search, I think of their AI integration kind of like how they integrated widgets into Google search over the past decade. So for example, when you look up an NFL game, they have all these custom widgets. AI is kind of just the next step of that, of a way to provide even more information and answering your question. So I would actually say right now it's way overestimated the degree to which AI is going to eat away at Google search, especially for the average person. I'm highly technical, I'm young, I'm into AI and all this, and I try everything, but I still use Google search quite often, and I use Google Chrome as my browser. So my first instinct for the vast majority of common use cases is go to Google. But I do think AI can pose a threat in terms of time used because there's so many new use cases you hadn't even really thought of. So Google is definitely facing the most amount of competition it has seen in a while. Yet they are facing the most legal blowback at the exact same time, accusing them of being a monopoly. And there are two cases going on, one over a search monopoly, and this is the one that's actually moving far along, and then a newer case over digital advertising technology, which I think is a weaker case compared to the other one. So a federal judge did just rule on August 5th that Google is a monopoly, and they violated antitrust laws to maintain its search monopoly through anti-competitive practices. But the more interesting thing that just came out of this is the proposed remedies. And this got pretty extreme. They were requiring Google to sell their Chrome browser to reduce its control over search distribution channels, which would be actually a pretty big deal. I use Google Chrome. The other one is data sharing, mandating that Google shares more of its search data with competitors to level the playing field. Another interesting one is contractual restrictions. For example, Google has a deal with the iPhone, making it the default search engine. So the judge wants to prohibit Google from entering into exclusive agreements like that, which definitely would eat away some at Google's moat. They also suggested limitations around AI and Google's ability to use search data to train artificial intelligence models. Could be something that ends up hurting them significantly in the AI wars that are currently going on. So I personally disagree with some of the rulings they had there, but this is the current reality. The next steps are that Google is expected to respond to the DOJ's proposed remedies by December 20th, 2024. There will be a hearing for the remedies scheduled on April 2025 and a final ruling anticipated by August 2025. It should also be noted that Google has indicated they plan to appeal, which could extend the legal proceedings. Now, whether any of this means anything or ends up happening, that remains to be seen, because this actually reminds me a lot of what happened with Microsoft when they were ruled a monopoly. And I was reminded of that when I recently listened to a podcast series on the history of Microsoft by Acquired. I've mentioned them a few times in the past. They do a great podcast. You guys should really listen to it if you're interested in the history of business. One of those episodes, they went really in depth into the DOJ lawsuit at that time. And I did not know that Microsoft was ordered to be broken up as a remedy during that trial. If my memory is correct, they were basically told to break up the company, one being the software side of the business, which would be Excel, Word, and their new web browser at the time. And then the other business would be their operating system business, Windows. And they were going old school, hardcore, trying to break up the ownership groups too. They said that Bill Gates could only own one of them and he could only work at one of them. Steve Ballmer could also only own and work at one of them. It was crazy. They were going really hardcore. But ultimately, Microsoft appealed and none of that ended up happening. But it definitely ended up psychologically impacting Microsoft as a company. They became far less aggressive. Bill Gates took a big step back. He was no longer the CEO. He moved to a background role and then ultimately left. And Microsoft stock ended up seeing a decade plus of no growth at all. Now, part of that was because they were trading at very high valuations during the dot-com bubble, but another part of that was just sentiment around the company and a lack of innovation. Growth of earnings per share did slow down at Microsoft in those years, and it was a highly profitable, great business, but this is not the earnings per share growth you think of when you think of Microsoft. It was not till 2017 when earnings per share started dramatically increasing at the company. So you wonder if there could be a similar psychological overhang that ends up happening at Alphabet in the coming decades. But despite the similarities being that they're big tech companies and there's, monopoly accusations, I don't really think you should focus too much on that comparison. They're very different companies operating in different business segments at different times and different decades. So this DOJ monopoly case is really just a big risk to be aware of. I'm not going to do a full analysis going over the merits of the case because that could be a half-hour video by itself. But I do think it's important to take a big picture look and remember that search is only one category for advertising. And while Google dominates that search category, there is increased competition. Advertising is actually a bigger business than ever across a more diverse segment of businesses than ever. You have search, you have social media, you have video, you have streaming services, you have website ads through the Google network, you have advertising on newsletters, influencer advertising. Then you even have more traditional ones like linear television, radio, magazines, newspapers. You have physical mailed advertising, you have billboards, and all of that is a big reason why I think the search monopoly case is a stronger lawsuit compared to the digital advertising technology case. I definitely do not think Google has a monopoly in advertising more generally, or even digital advertising. Digital advertising is a massive industry, and just one business through owning social media platforms being Facebook and Instagram, Meta, is valued at over $1.45 trillion, and their core profit driver is digital advertising. So before I get to valuing Google stock, let me just sum up my overall thoughts here. I personally do not think that Google is going to get broken up. I think that Google will appeal the decision, and at a minimum, this will be a years-long process, and I'm not really sure what will happen. I would also like to highlight that we just had an election in this country, and there's going to be a new Department of Justice. So even though the search monopoly lawsuit is already very far along, I think there will be a lot of changes in priorities. So if I was a betting man, I would probably say this is not going to happen. And even on Polymarket, which is a online betting market, they posted the question, will Google be forced to sell Chrome? And that's currently sitting at an 18% chance. So I would say it's not very likely. So let's take a look at valuing Alphabet stock. To do so, I'm going to take a look at analyst price targets, compare that to the current stock price. Plus, I am going to do a discount cash flow analysis on the whole company. And finally, this is really interesting, but I am going to do a sum of the parts analysis and value each part of Google so we can then get to an estimate of intrinsic value, whether or not the company ends up being broken up. So first, let's do the price targets. Currently on Wall Street, the average price target is $209.60. $2.64. That implies about 24% upside from the current stock price. The highest price target is $240 and the lowest is $151. And currently, the overwhelming number of analysts are bullish on the company, with 14 saying outperform and 37 saying buy. On a score of 1 to 5, with 1 being the most bullish, they have a consensus score of 1.58. And I think it's pretty hard on the fundamentals to not be bullish for Google stock. They operate in very high growth categories with dominant market positions, and it's already an extremely profitable business. So now let's do a discounted cash flow analysis, and this calculator is available on dividenddata.com if you want to follow along. When you see this pop up, just hit show more and it will autofill with all of the relevant financial data for whatever stock you entered, in this case Google. And you can edit to change the expected growth rates in future years for things like revenue, tax rates, capital expenditures, etc. And currently this defaulted to having 0% growth in 2027 and 2028, but I'm going to enter the numbers that I think are likely to happen. I'm putting the company at 15% revenue growth in fiscal 2024, which they're already on pace to hit. The first 3 quarters have already happened. And then I'll say 15% again in 2025, and then assume 10% growth in 2026, 2027, and 2028. And this is relatively close to what analysts are already projecting for Google stock revenue growth. Other important assumptions made in this are an increase in capital expenditures, which I do think is likely to continue happening. CapEx has grown massively over the past year, and it's now up to $13 billion a quarter. That gives it about a $52 billion run rate. And this CapEx spend is primarily for Google Cloud and then for internal data center use as well. And this all really has to do with AI related spend. And I covered this a lot in my NVIDIA stock review video. It's a trend happening at Microsoft and Amazon Web Services. So if you want to know more about it, go watch that video. But this is a trend that's happening and will continue to happen. So I am projecting CapEx growth to continue growing. And I do think it's reasonable they could be at $78.9 billion in annual CapEx by fiscal 2028. So here you can see the projections for free cash flow over those years, growing from $56.3 billion in fiscal 2024 all the way to $96.2 billion in fiscal 2028. And if you assume the company would be trading at a free cash flow multiple of 25, which is around what they currently trade at, then that would imply a share price of $144.10, which is actually 14% downside from the current price. But 25 is really the lowest multiple I would put for Google stock, given how high quality and high growth some of their business segments are. So I think a 30 multiple on it would be a little more reasonable, and that would give it an implied share price of $167.11, which is what Google stock is currently trading at. And I don't think there's anything overly bullish about my estimates here. If anything, they're somewhat conservative. So based on that, I would say Google stock is a great business trading at a fair price, which a lot of the time is all you can ask for. But here's something really interesting that I didn't even know my dividend data AI could do, but I tried it out and it worked really well. Since there is risk of Google being broken up, I thought it'd be nice to do a sum of the parts valuation for Alphabet, ticker symbol GOOGL. And this is basically looking at each business segment independently and then assigning a multiple that it would be valued at. So Google Services generates $115.16 billion of operating income in 2023. Given the high profitability and growth, a PE multiple of around 20 to 25 is reasonable. I would agree with that. Google Cloud is a high growth segment with increasing profitability, $40 billion of revenue, and operating income of $4.88 billion for the year. It is lower margin, but higher growing. And for this, it said a price to sale multiple of 10 to 12 times is reasonable. And I do think that seems reasonable. And then other bets, which is a much smaller category. Given the speculative nature, it gave it a price to sale multiple of 3 to 5. So hey, I'm proud of my AI. These are all reasonable estimates. Let's remember that Google stock is currently trading at a $2.08 trillion market cap. And based on this, it values Google's services segment at $2.5 trillion. That's with a 22.5 multiple. So based on that business segment alone, the stock may be undervalued. Google Cloud, it has valued at an 11 times price to sales multiple, putting the value at $445 billion. Other bets at $7.64 billion, and then a negative value for their corporate cost segment. So overall, if you value all of these together, the total value is $2.8 trillion. That would imply that the stock has 34% upside from here. And I actually think this is probably the clearest way to value Google stock, given how segmented their businesses are. So in conclusion, I do think Alphabet is a great business trading at a fair to possibly undervalued price. And that is why I just added Alphabet to my dividend growth stock portfolio last month, and I will continue adding to the position as it declines. And going forward, I will view any decline related to a DOJ lawsuit as a buying opportunity for the stock. But all of that is just my opinion, so be sure to do your own research before making any investing decisions. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you found any of the research tools I showed throughout interesting, then sign up at dividenddata.com. We currently have our Black Friday sale going on, and that will only be available for the next week. So now is the best time to sign up. You can lock in 50% off for life, and that gets you access to my new AI investment analyst that I showed throughout the video. To get the deal, just click the link in the description and pin comment, or create an account on dividenddata.com, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI. Thanks for watching, and I'll see you in the next video.